Hello, this is Michael Ball, Managing Director with Weatherstone Capital Management with a market update for October 2022. As a brief overview of the things that we'll be covering today, we'll take a look at the quarter that we had for both stocks and bonds, where things stand for the year. We will update some of the important recession indicators, both those that are positive as well as those which are negative. And then we'll have a discussion about the political cycle and how that can impact stocks, particularly around midterm elections, which tends to spark an unusually strong period for the stock market. We'll then look at some of the developing opportunities that we are seeing in bonds and wrap things up with an overview of the current positioning and some potential positioning that we expect to see in our equity and our fixed income portfolios. As we look at where market indexes stand as of the end of the third quarter, we're continuing to be on pace for the worst year that we've had for a combined stock and bond portfolio since 1974. Stocks and bonds both were down on the quarter, with the S&P 500 down about 4.5% and bonds down about 4% generally as well. Year to date, as you can see, indexes are quite negative, about 24% for the stock market, almost 15% for bonds. And even safe havens that are traditional, such as gold, have dropped. And then there had been some talk about how Bitcoin could be a great investment because it tended to diversify and not be like stocks and bonds. Well, it's performing far worse than any of those this year, having lost nearly 60% of its value. So this has been a year in which virtually every asset class is getting pushed down because of the weakness of the economy and the concerns over the rising of interest rates. As we look at some of the mounting risks of a recession, and this is one of the primary things weighing on the weak performance in the financial markets, we're seeing some pretty important indicators that have high levels of accuracy turning increasingly negative. Chief among those, the index of leading economic indicators has been down now for 6 consecutive months in a row. Historically, this has had a 100% level of accuracy of predicting a recession. It doesn't necessarily say how strong or how deep that may be, but it tends to be quite accurate in predicting that there will be a recession. We've seen that consumer savings has turned negative as of the early portion of the year. Consumers had still been saving money on balance as the pace of inflation was picking up. We've now seen that flip over to being negative to the tune of about $39 billion for the past few months on average coming out of consumer savings. We're also seeing credit card balances and things of that nature spiking higher as people try to adjust to higher inflation by essentially putting more onto their credit card to smooth things out now and hoping that things will get better shortly down the road. At the same time, we're starting to see loan delinquencies moving sharply higher from where they had been. And then finally, as it relates to the housing market, which can be an important component, having seen mortgage rates more than double this year has pushed an already fairly unaffordable housing market to almost record levels of unaffordability for most people. And so this could put pressure on home prices to begin to adjust lower if we don't see mortgage rates begin to come down in the near future. Fortunately, not all the news for the economy is negative. One of the more positive aspects is that consumer spending so far remains fairly resilient. And with this being over 60% of the total economy, that is a positive sign out there. Additionally, even though unemployment has started to uptick a little bit and we are seeing more headlines about layoffs with companies, there are still a lot of job openings out there, and the overall unemployment rate has not started to tick measurably higher as we would expect to see it do as we go into a recession. So that remains a second important positive. As it relates to the financial markets, we're hitting the midterm elections, and we probably all got tired of seeing enough political ads here lately, but there are positive implications from this for the stock market. And we typically take a look at this about once every 4 years. And so this is an area that we want to take and dive into a little bit deeper. If we take a closer look at how stocks have historically fared around prior midterm elections, we see that the performance has been strong beginning in October through April of the year following the midterm elections. We've only had one case since 1950 that showed a loss, and that one was pretty minor at less than 1% back in 1978. And interestingly, when we look at years in which we had a recession occurring during that midterm year, which are the ones highlighted in yellow, we've seen even stronger returns with an average return of 25% during that period versus all cases that averaged at a little bit over 18%. So what's the basis for the strong performance? Historically, it's been attributed primarily to the fact that once the midterm elections are over, that the party in power is going to try to do all it can to enact economic policies that have things looking good as we go into the presidential election year. However, with a number of these cases coming at times in which there is gridlock in Congress, then it doesn't necessarily hold up solely for that reason. But nonetheless, it is one of the kind of historical anomalies that seems to be quite persistent. And it also tends to be, at this point, one of the most positive potential outlook factors that we can find for the stock market right now. Turning to bonds, one of the most significant headwinds that we've seen for bonds right now is inflation, shooting higher and then staying quite a bit higher. And we're looking at whether bond investors are, willing to keep rates historically low relative to inflation, or if those are going to start adjusting higher. What we've seen here over the past few months is that we've been seeing interest rates continuing to trend back higher. Inflation has started to stabilize a bit more. So we are starting to come back a little bit better on what the after inflation yields are on bonds. But still, we're at some pretty historically low levels. This is something that we continue to watch quite closely to see if inflation stays persistently high, if we start to see bond yields continuing to move higher because of that, and investors essentially building in longer term premiums for inflation not being something that's going to be able to go away within just a year or two. Despite the headwinds, one emerging opportunity that we're seeing in the bond market right now is in high yield corporate bonds. We've seen the prices of these bonds drop quite significantly during the course of the year. At the beginning of the year, they were up close to about 100 cents on the dollar. They have been dropping and right now are tending to trade in the low to mid 80 cents on the dollar range. As an example of the importance of starting prices as far as what you're paying for the bonds and what that means for some of the future returns, this is a chart that takes information and goes back to 1999 and looks at, based upon what the starting prices are for bonds, what the returns are over the subsequent 1, 2, and 3 years. And so what you can find, obviously, is that the higher the prices are for bonds, the lower the total returns. If we start to get down to where we're at now, in that 80 to 90 cents on the dollar range, or if you can get below 80 cents on the dollar, you see that historically when you're buying at those prices, you're getting returns that are averaging in the double digits over a 1, 2, and 3 year time frame. That gets quite interesting, particularly for fixed income investors, because that's giving us returns that are in the ballpark of what you'd expect if you were investing in the stock market. And typically we're able to do this with less risk because we're higher up in the corporate structure in terms of how things are secured. And we also have a good sized chunk of the return coming from income as opposed to having to bet upon appreciation. So the current pricing is already starting to factor in at least a moderate recession, it appears. Whether this would be the low price for bonds, we really don't know, but it's something that we keep an eye on, and we'll see. But we're in the zone where historically that has been pretty attractive for bonds. One additional item showing the financial strength within the high yield corporate bond market is the record high recovery rate if a bond does go into default. With any corporate bond, you do have some risk that the company may not be able to meet its obligations, and as a result, then essentially the collateral needs to be liquidated to pay back the bondholders. In the cases where that needs to happen, and we go back and look at the history of what that's looked like, we're actually at the highest level of recovery rate that we have seen in the 40 years of the data that we have here. And so it's a good indication that a lot of the companies issuing high yield corporate bonds are pretty well collateralized, and that if in the somewhat unlikely event you do have a default, that you're getting back more of your money than what historically has occurred. With a lot of the funds that we'll use, we're leaving it up to managers to help to minimize that risk by actively looking at the bonds that they want to buy out there and minimizing the risk that they ever do go into default. But nonetheless, it's an interesting data point as we look at and assess the health of high yield corporate bonds. As we look at inflation, which does tend to be the primary topic of a lot of conversations these days, I thought it would be helpful to show a very long-term historical chart of inflation, where it's at currently and where it has been. This data goes back to 1914. Much of the early part of the chart probably isn't all that relevant because there's pretty different financial circumstances. But if we start looking at the 1950s to 1960s, we see that really, other than when we've been in the 1970s, it's been pretty rare to see inflation get up this high. We started to have an uptick in the mid to late 1960s when it picked up much above, a 2%. It started to run up into a 5 to 6% range. Then it came back down. Then we had a second wave higher, then a third wave higher as the spending from the Vietnam War and the OPEC oil embargoes of the 1970s started to weigh on things. Since that time, we've generally had pretty low inflation. We've only had a couple of cases since the early 1980s when it's picked up much above 5%. This one we've gone up higher than normal, and so one of the key questions, will this be something like the 1970s that takes a longer time to come back down, or will it be something that can be fairly quick? The reason that question is important is because if we look at almost similar time frame in charts in bond yields, we see that you've tended to have some very long-term trends out there, where from the 1920s up into roughly the late 1940s, early 1950s, bond yields tended to trend down and then slowly moved higher, and then fairly quickly moved higher as we got into the late 60s, into the 80s. And then for the past 40 years, with just a couple of exceptions, they have tended to trend lower. And so if you remember back to the prior chart where we saw inflation start to spike up in the late 1960s and then have a couple of waves in the 1970s, you can start to see those when interest rates kind of move from that 5% up to 8 to 9%, and then the two spikes afterwards, ultimately getting to where corporate bonds yielded close to 17% as we got into the early 1980s. And that's one of those points where we had very big inflation premiums built into bonds. So if we're unable to see inflation start to come under control, we need to look back at this late 60s, 1970s time period to give us a fairly good roadmap as to what may happen to bond yields and some of the implications that it may have across other financial markets. This is something that we continue to monitor and look at fairly closely because the ramifications can be quite significant. So in terms of how this has impacted how we're positioning the investment portfolios, if we look first at the fixed income portfolios, we favored ultra short bonds during most of the prior quarter, alongside some positions that we have had in floating rate bonds. Over the past few weeks, we've begun to add in some additional positions in floating rate bonds and some new positions in high yield corporate bonds and some modest sized positions in some portfolios for tax-free municipal bonds. We believe that a moderate recession is already priced into a lot of the economically sensitive bonds, and with relative strength from the consumer side and corporate earnings still looking pretty strong at this point, we think that this is reasonable to pick up some of that risk. If we see that we have greater weakness in home prices and other things that could lead to a deeper recession, then we may need to move back to a more defensive position if conditions warrant. In regard to equity market positioning, our short-term risk measurement models have continued to be mostly negative during the third quarter, and as a result, we've been holding above average amounts of short-term bonds or cash. As mentioned, there's historical precedent that we typically will see strength as we get close to and move past the midterm elections. That may account for a little bit of an asset allocation adjustment, but we're looking more at what we're seeing from our short-term risk measurement models and other important quantitative indicators. If market conditions do improve, we're looking to add exposure to the energy and healthcare sectors this quarter, as they're likely to stand to benefit from a slow growth earnings environment for many industries that are out there. We're also looking to incorporate funds that are more value focused. Typically they're selling at better prices relative to what you're paying for a dollar's worth of earnings or a dollar's worth of assets. And those do tend to hold up with a bit less volatility and oftentimes better performance in these choppier and slower economically growing times. In summary, as we wrap things up for this quarter, the above average levels of inflation that have not really rolled over too much and the strong interest rate increases by the Federal Reserve have kept the financial markets under continued pressure because of the uncertainty. In this type of an environment, we're continuing to hold sizable amounts of short-term bonds or cash and are being more defensive than normal in our equity and fixed income positioning, as it's our primary focus to look to preserve capital and have cash available to buy attractive opportunities that may show up in these types of environments, which historically has happened as we've gone through bear markets. And something to reiterate that we had talked about in the prior quarterly commentary is that the bottom of a bear market is typically the point of maximum pessimism. And several indicators that we look at continue to show that we're probably getting fairly close to that. And so unless we start to see above average inflation numbers or things like that, we could have some reasonably good opportunities starting to show up here in the coming weeks and months. With that, we'll wrap it up for the quarter, and we'll touch base with you again with another update after the end of the year. Hope you have a great holiday season, and reach out to us if you have any questions. Thank you.